Thank you very much. I'm really conscious of the fact that this is a workshop talking about how business can become more resilient, and part of that is managing risk, and we'll talk about risk. But one of the other things in farming is that we need, with risk, the opposite of risk is opportunity. And we need, in farming, we know we need to be prepared and ready and capable of taking on opportunities, because if we don't take on opportunities, then we're not going to be as successful as we need to be to survive the risky times. So I'm going to talk about, I want to keep that in mind, because I think it's easy for someone to come here and talk about all the risks and things that you need to look at. And one that you forgot about is production risk. You know, production risk is something that you guys are really, farmers are really good at managing. And so I don't think anybody needs to come and lecture and talk about production risk. But I want to talk about our business, obviously, is interested in the markets, what drives the markets. And in having an understanding of those markets, we'll identify risks for sure. But right now, it would be crazy to be talking just about risk, because we need to be talking about opportunities as well. A little bit of background, my business is, I set the business up 25 years ago. I think I was with Elvis and started up Mercado. We then sold the business over a period of time to Ruralco, and of course Ruralco is now merged into the nutrient business. So we're a nutrient business. It's interesting when you start off as a private small business, you think, oh, this is great, it's a bit like doing your own farm. But there's also great things about being part of a big organisation, and so Nutrient allows us to go around and talk to people around the countryside, and also to talk to their people about trying to upskill and improve their knowledge and understanding. The other thing, just for transparency, I need to say that I'm also a Director of Sheep Producers Australia, so that's a representative organisation of all sheep producers. So they like it that I let people know that I'm part of sheep producers and I come and talk to you. So let's talk about the markets, but what I want to, in order to understand or have a view of what's ahead of us, we need to understand where we are in the markets. And to understand where we are, we need to understand how we got there. So I'm going to take a little bit of a journey. I've asked Emma to tap me on the shoulder when I get to the end of my time, but bear with me. So understanding the path to wealth in the developing world is the key to why we're now in a situation where your commodities are being highly sought after. And if you think back, the whole story of these communities started with industrialisation. And if you remember back to the global financial crisis, and Australia actually skated through, we were remarkably resilient as a country in the global financial crisis because of our exports of minerals. And those export of minerals were going to countries like China to build their industrialisation. And what that meant was that they were then able to move people from rural communities into the cities. And moving those people from rural communities into the cities meant that they had higher income potential, they created factory workers, and that's your urbanisation. So that was a conscious move of these countries. It builds family wealth. So those people, it's interesting, in the people in rural China contribute nothing to the GDP growth of China. They're subsistence farmers, basically. And if we know how much GDP growth China's had, it's come from these businesses that moved. And we know that nations with higher GDP, higher urbanisation populations have higher GDP growth. So why is that important? We know that demand grows in developing countries for our meat products and our generally higher value foods. So these countries, these people now who are moving into these factories, getting more wealth in their family incomes, all have iPhones. And they know exactly what we're doing in our countries, they know exactly where they're aspiring to be. And we know that, and MLA have done a lot of work on this, we know that at certain levels you can see that as the income per household grows, so does meat consumption. And the important thing about all this is that most of these people going through this stage are in Asia, on our doorstep. And obviously China's a very easy country to talk about because it's a great example of what's happening, but it's not the only country where this is happening. And if there's one Weird takeaway you get from today, you can remember that there's more people living in that bubble in the world than anywhere else. And so we've got this concentration of people and we've got this growth in income. And so by 2030, which is not far away, there'll be 3.2 billion Asian people who are classed as middle class. And the reason, and if you look at it in the US, it's 10 times what would be in the US. Now, from our point of view, as an exporter of high-value food commodities and fibre commodities, that is really important. And you can see why people get excited and upset or worried when China starts to battle it safe and talk about doing things to us as a commodity supplier. I mean, we should be a bit concerned. But what we should also remember is those 3.2 billion people in Asia are going to be demanding the sort of products that we're producing. And we're already seeing that. And so there was a line back when go back to that mining boom, when the mining boom started, people said, what happens after a mining boom? A dining boom. And hopefully that explains why we're having a dining boom. You go from, you industrialise people, they get more money, and when they get more money in their household incomes, they want to spend it on the sort of products that we produce. So when my kids come home from Melbourne or Newcastle or Cairns where they live and they say, Dad, you've got to get out of agriculture. No one's eating meat anymore. So don't worry about it. You guys don't care if you don't eat any meat. There's a whole lot of people in the world, hundreds of millions more people in the world who are adding meat to their diets for the first time. And they will continue to do that because their wealth will continue to grow. I mean, we know all about poverty in the world, but the reality is there are more wealthy people in the world now than there ever have been. And as a threshold, I don't think I've got it on the next chart, as a threshold, when they get 35,000 US, that's when they start to peak demand or peak consumption of meat in their households. So that's the story about the opportunity. What are the drivers? Globally, they're primarily population growth and rising income. You know, we can talk about all the things we do, but the bottom line is that this demand is actually pulling our products through. Our job is to actually produce it and keep it safe and keep ourselves positioned at the top end of the market, which is another story, but by and large, this demand is very strong. And as I say, the growth in the wealthy households with more than 35,000 income is the key. The orange lines are where the percentage increase that we're going to see of those households by 2024, so not far away, and China will have 106% or double the number of households. So I think it helps explain why China doesn't go all out crazy and ban our iron ore or our meat products and things like that, because they have this demand that they have to meet. And I think one other famous communist leader, Lenin, said, our government is only 3 days away from anarchy, 3 meals away from anarchy. If we don't feed our people for 3 days, we've got anarchy, and these countries are well aware of that, and the people in the countries, as I said before, are well aware of what we're doing in our countries, in the US, in Europe, etc., and that's their aspiration. An increasing global demand for red meat will be certainly supportive of beef markets. It's not going to give any, it's not going to make our people in buying in Sydney and Melbourne any happier. They're going to have to pay up to compete for our products. And so the bigger story here is that we're in this position because we're an export country. We export 70% of what we produce. We're also at the high end of the markets, and the most expensive meat in the world is Australian meat, because we're considered safe and secure. And so if you think about it, they're the things we've got to focus on. How can we produce more, and how can we produce it better and give our customers more confidence that we have this continued safety. So the whole biosecurity story that's happening right now is absolutely vital and critical for us. And I did a podcast with Mike Stevens, some of you know Mike Stevens, the other day, talking about what can we do. And so one of the things he said his group's doing, Meridian's doing, is they're contacting all the politicians to say, make sure they understand how important this biosecurity story is now. But he said we can also make sure that our farmers and our clients understand how everybody does their bit, and making sure there are no mistakes. And I was saying to Charlie earlier today, you know, there's two real risks on the horizon right now. It's lumpy skin disease, which is a cattle skin disease, which I think will probably blow in here. It's a mosquito-borne disease. It will probably blow in, and we'll have to deal with it. But the other one is foot and mouth disease. And for foot and mouth disease to get to Australia, we still have to do something wrong. We have to have a hiccup at the border, or somebody has to bring in some product that's contaminated, or animals have to cross-match. And if you think, you might remember that there was a case about 1.5 years ago where a piggery in WA was heavily fined for bringing in semen without it being registered for their piggery. And they're the sort of things that could you know, trigger something like this. And should something like that happen, and we might be a little bit off track here, but 65% of our meat export markets require us, or require our chief vet to sign a document that says we don't have lumpy skin or foot and mouth. If he can't sign that document, then those agreements have to be either renegotiated or they won't continue. And you can imagine that those sort of agreements are with the high value products. So we'll talk a little bit about the what this all means. Global beef consumption is going to continue to rise. Now, it will mean that Australia won't meet that gap, but it means other countries will, which will mean that our product will still be in high demand. And the challenge for us is to make sure that we're always different from the South American product. South America's got the big amounts of beef. They're an erratic supplier, so you know when they do get market demand, they then put tariffs on it, so the domestic price doesn't go up. They get diseases, all that sort of things. But we have to make sure that while this demand is growing, we continue to position ourselves at the top end. Sheep meat consumption, I've got to say, I can't. I mean, I was a shearer for a while. I worked at Elders as district wool manager. I've been involved in sheep all my life. I never thought I would see the time when sheep meat would have such a strong outlook for demand and for the markets. Of course, we know the challenges is in producing it here. And we're seeing that now. The sheep flock is at an all-time low. But the demand is going to be coming, it's going to continue to increase, but you can see it on that chart on the right there. It's going to come from the developing world. There are countries now that are, for the first time, starting to get an appreciation for sheep meat. India will be a good example where we just signed a free trade agreement. Now, India has a lot of Hindu population which are vegetarian, but it has a huge Muslim population which love sheep meat and goat meat. So what does that mean for prices? Well, this is the retail price of meat. I've left the purple line in there, and I say to all the people I talk to who are basically broadacre farmers, thank God we're not in chickens. The reason behind that is that when demand increases, we can't quickly increase supply of red meat. In fact, we have droughts where the supply goes down. However, if demand increases for chicken, you put another shed up, or you put another chicken farm up. So you can quickly adjust to that. And we'll see that happening in the future. Chickens and pigs will continue to grow, but they will grow their markets, their price won't grow the same as our red meat does, because their supply will be matched by increased production. And their models then are changed also. Their model is more about efficiency. So can we produce a kilogram of chicken or a kilogram of beef for less or quicker? Whereas with our red meat, we want efficiencies on our farms, but we'll also have this demand that keeps pushing faster and stronger than we can produce. By the way, another useless bit of statistic, the chicken we buy out of KFC is 36 days old. It takes them 36 days to grow that chicken. Enjoy. Let's talk a little bit more about cattle. The Eastern Young Cattle Indicator is the green line. For clarity, the 90 CL, for those who don't know, 90 CL is a really good benchmark of a meat product It's like the stuff that goes into hamburgers. It's trim. It comes off every animal, so it's a benchmark indicator. We can see that both the Eastern Young Cattle indicator and the meat price and the cow price have all been moving upwards. Normally the 90CL price or the meat price is above the cattle price. Makes sense, you know. The meat should be worth more than the sale yard price. But what's driven that change, if you look back over time, that's what it's always been. What's driven that change, though, has been the recovery from the drought. So instead of having people selling young cattle to reduce their numbers to manage their drought situation, we've had people holding them back and in fact buying them, so it's pushed the market. So one of the things we need to... Oops, my battery's running low. Yep. One of the things we need to be careful of is that last surge there, I'm agreeing with what Stephen said. I'm not sure if I can put a crap there, but I'll ask him on that. Is that pressure will come off when the restocking demand eases. So it'll either ease because we've restocked to the level that the country's comfortable with, or the season changes. So one of the things to be careful of.
Oh, no.
One of the things to be careful of is to watch carefully what happens in the north with cattle. So because most of the cattle, 50% of Australia's cattle are in Queensland, Northern Territory and in the Kimberley. So if the monsoon, which they rely on the monsoon, if that fails next year, then at these prices, we think we'll see a quick sell-off of cattle, a rapid decline in the herd, which will press the market down. So, and it will affect all cattle prices in Australia. So we need to be aware of that. Am I pressing?
Apologies, yeah, just on the moment you might need to
Which one do I press? Oh, that one.
No.
Okay, so we've got the EYC ambling lower. Poor Northern Windsor, I mentioned that. We talk about being fortunate, and I think, you know, I know as farmers we don't like to say we're lucky, but we have been really lucky. Like the COVID crisis came when the drought broke, so one cancelled the other, if you like. We think that the cattle price is going to come off when the restocking is finished or the northern monsoon is not so great, but it looks like it's going to coincide with the end of the herd liquidation in the US. So the US is liquidating its herd down. They do it quite regularly. It goes up and down. They're coming down. We know when they get to a level where they've got low numbers, they then rebuild, which means there's less cattle being slaughtered. If that coincides with us having more, then well and good. It should be working out. Thank you. Yeah. Here's another change that's happening, and it will continue to happen. If you think back to the chicken model. So, for the first time in December 21, more than 50% of the cattle slaughtered came out of feedlots. First time ever. So you see on that chart, the red line. And part of the reason was that we had less coming off grass, but we're maintaining those cattle on feed. And I think we're going to see that that's a model we'll see more with sheep and lambs. We'll see where there'll be an incentive for those people who have got ewe flocks to breed more lambs, not take them through to finish, to breed more lambs, turn them off into people who are going to background them and finish them perhaps on a grain finish, like we see in the cattle industry. Now, in the sheep industry, the feedlotting is in its infancy, but if we're going to grow numbers, then that's the way it will happen. We're not going to suddenly have people, you know, stop planting crops, especially when wheat's above 400 and canola's above 1,000. They're not going to stop planting crops and put sheep back on that cropping country. But what we might see is that the people who are still in sheep, and what we think will happen, is that they'll focus more on their breeding, especially in areas where it's suited to breeding, focus more on breeding, have them for a shorter period of time, because the turn-off and the returns to those businesses will be higher by getting off more numbers. And to do that, we need a feedlot system. We also need it for our markets. One of the challenges with the lamb industry and the slaughter process is that a whole lot of lambs come off at one time, and then there's none for a while. And so if we can spread that, and it's interesting, I was talking to someone from Verback. They've got projects in Tassie now where they're looking at even bringing the breeding back later, so that the lambs come off later. And in other areas in South Australia, bringing the breeding earlier, so the lambs come off earlier. Just spreading that supply is going to help our processes. Gundagai meats is a good example. You know, they know they can ramp up in the spring. It's difficult now to ramp up because of labour issues, but if we could spread their peak capacity further, then they would be able to better meet the demand of milk. 22% of feedlot capacity is owned by processors, and one of the things that's been happening is that the supermarkets, well, you can go into a supermarket at any time of the year and get exactly the same steak. It's amazing. And the way they do it is they only buy at feedlots. So that, which is a good thing, because for us as farmers, feedlots have to get cattle from somewhere. They have to have someone breed them. And the demand that's coming from those feedlots is going to be strong and consistent, we think. The other thing we could, and we just measured on that bottom chart, the feedlot capacity. We've got about 1.4 million head of cattle capacity at the moment. It's just over 1 million on the feed. But that capacity is there ready to try and keep ramping up when they can afford it. If you think about it, if you look at the green, dark green line on the bottom, you know, the amount of cattle coming out of feedlots to be slaughtered has remained consistent, which is a really interesting thing because at the moment we've got record grain prices and we've got record young cattle prices, and yet feedlots are still consistently turning through the same amount. So they must be making money, which tells us that that demand is there, which is a really strong pointer for our beef industry. Lambs, it's been interesting that the season has been marred by processing challenges, and yet we've got through pretty well. The one thing that's flipped around is that the price in the spring for lamb was higher than the price now. Now this has happened before, but it's unusual. But it's explained more by the processing challenges we've had. And I mentioned before about India, the UK free trade agreement. We've got this fantastic spread of markets. Talk about managing risk. If you want to manage risk in the meat industry, you would spread your markets over a whole lot of areas. I think, I'll talk about China in a minute, but what we need to do is continue to be able to meet those markets, because if you don't, they go somewhere else. So that diversity of markets is a really good risk manager for us as an industry. I can remember in the late 80s, we were told that our lamb carcass weights wouldn't go over 20 kilograms. You know, the supermarkets wanted these lightweight little trade lambs. The reality is that lamb carcass weights have just gone up and up and up, which is good for us as an industry because you're getting more kilograms to sell. It also means you can build businesses that background and finish lambs, and knowing that we've got a good market for it. The last quarter, the average carcass weight was 25.7 kilograms. 25-year trend of rising lambs. Now the main reason for that is two things. One is the demand, which is the US, loves a heavy lamb. I'll show you a little bit more about that in a minute. But the other one is the backlog of slaughter, and the background we've talked about means that lambs are getting killed later and coming out as heavy weights, which is a good thing. It's certainly generating more income back into our industry. This is the China story. So the two big exporters of lamb and sheep meat in the world is us and New Zealand. The only two that really matter. You can see there that New Zealand has a really strong focus on China. We're not so focused. It's an important market of ours, but it's not as much as what New Zealand has. In fact, if you look at the US, and sorry they're not the same scale, but tonnages are roughly the same for us, Australia going into China and the US. But New Zealand has a very small percentage of the US market, mainly because they're slaughtering their lambs at 17, 18, 19, 20 kilograms, whereas we've got the heavy lamb. And I think if you look at it, I mean, again, that diversity of markets is really good, but also we wouldn't want to be completely reliant on China, especially in the current climate. You know, we'd be looking to try and diversify if we hadn't already diversified our markets. And this is the reason for the US growth. COVID really added a new dimension to that market. So up until COVID, most of the land that went to the US was for cruise liners or restaurants. But in COVID, the people buying the people managing the households stopped going to restaurants and started taking meat home. And we know that because they started buying smaller cuts of lamb, and that opened up a whole new market. Now we think that will continue because if you look at this chart, you can see the green line is US production of lamb. It's been declining over a long period of time and not going to turn around. Their consumption has been going up, and the only way it can be met is by imports of lamb. And we know that like the US, like everything big, heavy, big is best, we produce those heavy lambs. So again, if we go back to my discussion about risk and opportunity for you guys, if you're going to set up a business where you're going to either supply lambs to a finisher or be a finisher, then this sort of information gives you confidence that it's an area to go into, area to have a crack at with a lot of confidence. And again, I think the challenges for the sheep industry aren't the demand, not demand. The challenges for the sheep industry is managing sheep and labour issues. At the same time, we talk about all that demand and we've got the flock at 100-year low. I just want to quickly show you an example here. That's lamb exports. And then this chart here, the top orange line is measuring the value of exports. So we're doing it in cents per kilogram, but all we're doing is saying how much did we export, what was the total value of exports, and divide by how many kilograms. And it's a rough measure of how the market compares to the sale yard price. The bottom one is the sale yard price. And you can see at the end the gap is just blown out. Now it tells us the processors are selling meat for a lot more than they're buying it for, which is a good thing. I mean, you want them making a profit. But it also tells us, if you look at this chart, it's a record spread. So that's the difference between the lamb indicator and the export value. It's never been at 500 cents before. It's almost at 500 cents. So it tells us that, and I think watch carefully over the next 2 months, when supply starts to constrain and the meat works suddenly start to have a little bit of capacity, we'll see the lamb price surge up. And so what this tells us is that looking to the future, if we go back to those normal levels of difference in price, that the lamb indicator will go to somewhere between 900 and 1,000 cents again. And that's really important for our new season's lamb. We know the new season price is basically something discounted off the winter price. So the higher the winter price, the better. And this is telling us that this winter price has got the capacity to surge up when supply drops off, because processors are going to want to be putting through as much lamb as they can because of the margin, and they've got a fair bit of margin to play with before they start losing money. There'll be times in the winter when they lost money. This year they might make money all the way through. Yeah. So here's what's ahead. Flock expansion. There's no doubt that there's an intention to increase the flock. That's going to be very difficult. We know that. Not a lot of sheep about, labour constraints, all that sort of things. Processing challenges are going to continue. And you know, my confidence that they will be improved is that when there's a lot of money to be made, it's amazing how people can figure out how to process. And at the moment, there's a lot of money to be made, but the growing demand is a strong story. So wool and fibre, quickly moving through wool and fibre. The big story is that we recovered out of COVID, and you know, I don't think we realised how amazing that was. If you talk to some of the wool exporters, there were times when they were ringing up their processors in China and there was no one to answer the phone, even. And yet the market got through, recovered. Fine wool price is at record levels. I'll show you a little bit more information on that in a minute. One thing to watch with fine wool, talking about risks, there's no doubt that fine wool can easily be oversupplied. And if you look at those low levels, so you can see there that's the difference between 17 micron and 21 microns, the low levels are the drought years. So as soon as we get a drought, as soon as we have drought impacted fine wool on the market struggles and collapses. And so watch carefully with that. If the season's starting to fold in, not just in your area, in areas where wool is produced, then be prepared for fine wool prices to come under pressure. And so don't carry final in that situation. In fact, I find it difficult to come up with a reason to carry final at any time. Either prices are very good or we're in a drought and there's plenty coming on, so moving on. Interesting, I thought I'd put this up because it applies in your area as well. In 1990, we had 160 million sheep and we had about 14 million hectares of crop. In 2021, we've got 65, 70 million sheep and 22 million hectares of crop. Now that's not going to change. There's no reason for that to change. So it means that our supply of sheep is going to continue to be constrained. And if we look at, again, looking at risks, I think the cattle industry has a risk that other beef from other markets can flood into our markets and supply them. It's not a high risk. I mean, South America is the big challenge, but they tend to muck up. Things go wrong and they one step forward, two steps back. But with sheep, there is nobody else. New Zealand has a record low flock. The world has a record low flock. It seems like we're giving you stupid stats all the time, but the biggest flock in the world is in China. And yet the average flock size there is 2 or 3. So those sheep and that wool doesn't actually get to market to compete with ours. Never will. So we have this situation where we're very unique with sheep in this country. Again, I remind you, I'm Director of Sheep Producers Australia, so I might be a bit biased here. But you know, we should see the demand for sheep meat and wool remain strong because the world is growing and getting more affluent and we are constrained with our supply. It's just that perfect equation, if you like, if you're a seller. 5 minutes?
Yeah, 10 minutes.
Thank you. 10 minutes to go.
Yeah, we're running quite ahead of time.
We're ahead of time.
Yeah.
Thanks for that. So the other one interesting, and I'll put up there a question. So, how has grain won the fight for acres? And when you look at all the benchmarking companies, they tell you that benchmarking sheep do well, and yet we've had this massive decline. And so, I don't know what the 100% answer is, but one of the reasons that grain has done well is that it's innovated. It brought in bulk handling. So instead of handling a bag of wheat, nobody handles a bag of wheat. I reckon I'd go to Marcus and talk to those young blokes who go back on the farm and say, if you're going to pick up a 3-bushel bag of wheat, which weighed, what did that weigh? 83 kilos. I was looking for pounds, but yeah. So what it did, it brought in bulk handling. It brought in bigger machinery. When I left the farm at home, Dad put a cabin on the tractor, which is bloody annoying. And we also got a hydraulic wool press, I might add. But it's then had precision farming, used chemicals smartly, better breeding. Sheep, we still drag the sheep out and crunch it. Not all of us, but a lot. We still sheep. So the innovation, in my view, has been why, because when you look at the figures, people don't make any more money out of cropping than they do out of sheep. In fact, there's an argument to say they take on more risk. You can be a year where you get nothing. With sheep, you keep the light, you're going to get something. But anyway, we're not here to talk about why grain is one to fight for acres, although we can gather that I'm a bit annoyed about it. But hopefully we're going to see that in a lot of the country that where sheep are the best product to make money, those numbers will either be maintained or even increased a bit, based on the demand and the margins and the profits we're going to see out of the sheep. Production of farm bales. The main thing there, as a percentage of the clip, we're actually producing more 19 micron and finer wool than we ever have. And that's a good thing. Number one, it's worth more money. But number two, it's what our customers have demanded. And it also differentiates us. We're the only country that would call, a lot of other countries would call 19 and 20 micron fine wool. We don't even call that fine anymore. So we have this special product, again, which is going to position as well. And just quickly, quality schemes. I've been around a long time. For those who were with elders years ago, we had clip care. Unfortunately, it failed because we couldn't actually develop a market for it. oil couldn't develop a market for it. It's been interesting that now we've got quality schemes being driven by the customer, and it's putting a price premium in there. Now, I'm not going to talk about the challenges of being in a quality scheme. I mean, that's a thing for every individual. But the reality is that we've got, most of the, talking about responsible wool sourcing here, just one product, RWS wool. Most of it comes from South America, South Africa, I beg your pardon, and a bit from us, and you can see the breakup there. But this is the premiums for good quality East Australian merino fleece wool for the season to date. So you can see we're talking, 150 to 250 cents a kilogram. Now, I would never have thought we would ever see something like that for something that's no different. I mean, if you look at it, the 18 microns quality scheme is the same processing capacity as the 18 that's not the quality scheme. But somebody is prepared to pay to say that this is part of the quality scheme. And I don't know whether this is a risk or an opportunity, but we're going to see more of that happen in the future. Customers are going to come to us and say, what are you doing with your stock? What are you doing with your land care? Even things like, how do you treat your staff? We're seeing all of that come through under the sustainability bracket. And in this case, they're saying, if you do this, RWS, and I'm not here to talk to your wool broker about what's involved, we will pay you this. And that's the first time we've seen that. Now, whether that lasts forever, time will tell. But it's an interesting situation to evolve right now. And we think that, we all hear about the carbon and sustainability and responsible farming and all that. They are things that we're going to just have to suck up. I was talking to Ed Story, and Ed Story, I did a podcast with Ed Story. There's a chief promoter of our podcast again. And he was quoted on the ABC as saying, I'm not going to be lectured by any inner city elites about how to run my farm. And we don't like it, we won't be. But the reality is that they are the customers, and they're going to be telling us via the markets what they want. And that's where we sit in the fibre market. So we had a change in supply, we had a big change in supply, the price went up dramatically. The size of the dot is how big we are in those markets. So again, that can be a good or a bad thing. It's a good thing if we can position ourselves as a specialty fibre in those markets and tell people that you're not just getting a jacket or an undershirt or whatever, you're getting a story that comes from the Australian sheep, from the Australian sheep farmer. And I encourage you to have a look at two programs. One is Trust in Australian Wool, is a program that wool producers have introduced, and it's telling our customers what we do here. Because if we don't tell them, they're going to come back and say, why don't you do this, this, and this? But if we tell them what we're doing, and by the way, here's a great product, then we can be ahead of the game. This is a bit depressing, but that was the Korean War. Does anyone know? So this is cotton prices, and that's wool prices. Anyone know what the spike in cotton was there? That was the US Civil War. So all the producers were in the south and all the mills were in the north, and they couldn't get production. And then back here, we had the Industrial Revolution, which changed things dramatically. And coincidentally, it was the time when the Australian merino industry started. So in real terms, we haven't had great prices. Prices haven't been going up. But we as a country have been more productive, been more efficient, and that's what sustained us. But we'll see more of that. And maybe we're seeing, we'll see a spike again. But the thing to remember is at the end of the day, it's our production systems that get us through. So this is what's ahead for wool. Processing challenges in China. We are relying on China. That will change over time as their processing gets more expensive and cheaper countries come on board, but at the moment we're relying on that. Now I just want to put up, to finish, Emma, thank you. I just want to put up a couple of observations about managing risk in the context of what we talked about here. We know about production risk, but I said right at the start, Australian farmers are the best at managing production risk, simply because we've had to learn it. We wouldn't have survived without it. The other risk is price risk, and our business is obviously in risks of managing price risk. One of the challenges for farmers is that what's a good price? What's a price that we should lock in? Can we lock it in? And, we've had it where people said, look, go and calculate your costs, work out your break even. Sounds like a good economic theory. It sounds like a good thing an accountant would say. I can tell you that farmers don't do it. Because for a start, it changes a lot. And it's bloody boring. So should we be managing price? And one of the things that I think we should look at is what is the price compared to previous history? So when our wool broker says, you can get 1900 cents for your 18 micron for next year, what does that mean? And so what we think is go back and use previous history. When did I last sell? Did I sell at 1900 cents last year? If I sold at 1800 cents, then what he's telling me is I can lock in at a higher price than last year. Is that attractive? If I sold at 2000 cents, he's saying I'm 10%, I'm 5% below. How do I feel about that? What do I think about the risks? What does it mean to my bottom line? Last year at 2000 cents was a record cracker. Banked more money I've ever banked. Do I want to do that again, or do I think I'll write it out? So I'm talking about, and I got a bit frustrated because we've got a financial services license, mainly because we advise farmers on hedging and managing risk and forward selling. But it doesn't happen. I think last year 1% of the Australian wool clip was forward sold. So there must be a reason for that. I can't be right all the time, I'm probably wrong. So the real reason is that it's not something that farmers want to do to manage risk. So perhaps we should be looking at it at times and saying, what is the opportunity? How much money am I banking if I lock in at this price? And the easiest way to figure that out, clips don't change much from year to year. The easiest way to figure it out is what was the indicator when I sold last year? So if my clip is 18 micron and I sold last year and the indicator was 2000 cents, and if next year's forward price is 2000 cents, then basically I'm saying I can lock some of my clip in at the same price I sold for last year, without any risk at all. What else? Make sure you include all commodities in your assessment of risk. And the beauty of being sheep for a start is that we've not only got risk with wool and opportunity and price income, we've got it with meat. And if you've got cropping, you've got another, so you're diversifying your risk anyway. So think about, and I'll show you percentile tables in a minute, but think about what is selling. If you're going to reduce some of the risk, what is selling well? No good selling my barley forward, but it's at $100 a tonne. And if wool's at 2,000, why not sell the wool at 2,000 and take the risk on the $100 a tonne barley? Okay? So how do I know if it's a good price or how it compares to previous? Well, one of the things that we found useful in looking at it, rather than looking at charts. I know when farmers look at charts, they look at the high bit. What a percentile table tells you is, so this one here is since 2000, so it's over 20 years. The Eastern States Trade Land Indicator has ranged from 124 cents to 966. Currently it's 778. It spent 89% of its time above where it is now. Sorry, below where it is now. It's been lower than 778, 86% of its time. So 778 sits in here somewhere. If you look at, let's have a look at wool. If you look at wool, let's take the 19 micron indicator since 2010. This is a slightly different time frame. It's ranged from just under 1,000 cents to 2,500 cents. Okay, most of my farmers look at that and say, gee, that's a good price, I'll do something then. The reality is that it's spent 90% of its time below 2,099 cents. At the moment, it's at its 73 percentile, which means it's been 73% of its time since 2010 below where it is now. If you look at 18 micron wool, it's 86% of its time lower. So if you sold a barb of 18 micron wool every week in 2010, from 2010 onwards, 86% of that time you'll be selling at a lower price than it is now. So that just helps assess the risk. Have you got any questions on percentiles or any comments?
Yeah, what
Or is it too early in the day?
what would you like go below? Like, yeah, like from those percentile figures, what would you not?
Good question. What wouldn't you say? Well, I can tell you that that there were farmers in the last 12 years, what are we, 2022, 12 years selling at $9.98, and there was farmers selling at that price in the auction. All right, that's the reality. That's the range of prices that were there. If you're forward selling though, we don't have to forward sell. I mean, sometimes when the wool goes to auction, we have to sell because we need the money or whatever. We don't have to sell. So Emma's question is, at what price wouldn't you forward sell? Well, you certainly wouldn't sell below 50%, because what that's saying is a 50% chance of the market being higher in the future, 50% of it being lower. We take our chances. As a general rule, in our experience, Emma, and there's no one rule fits everybody, most of our clients, especially if they're selling grain or wool, look at the 75% of it. They say, well, if it's above 75, I will sell something. Now the question then is, how much do I sell? Let's say we've got a 100 bar wool clip, and we can sell it in 20 bar lots. If the market's at 75% and I haven't sold anything, I'll probably sell 20 bars today. If the market went up in the next 3 weeks or 4 weeks or 6 weeks, I might sell another 20 bars. And then I'd have a look and say, well, what's the risk? If I'm getting closer to shearing and the market's going up, my risk is reduced. I've sold a bit and the market's gone higher than what I was happy to sell at in the first place. The market was very low, and you can see here, we've got crossbred, we've got people who've got merinos and crossbreds. The 28 micron indicator at 410 cents has spent 98.5% of its time higher than where it is now. Now, if you're a crossbred producer, you're probably saying, yeah, I bloody knew that. But if I was saying, let's say I'm going to go to the auction today, and I've got my clip up there, I've got the crossbred ewes, and I've got my merino flock, I certainly would be holding my superfine weaners. I'd be selling those because of the high percentiles. I might be holding, let's say I've got 20% of the clips in that, I'll hold that. And then the rest of my decisions are made up on how much money do I need right now, and how much am I prepared to carry on as a risk. And whenever I talk about this, it sounds like, oh, it's all a bit vague, but the reality is it's individual decisions. There's not one model that fits everybody. So all I'd say to you is make sure that you have a look at all your commodities. So if you're a grain farmer and a wool producer, then you've got two choices. You've got two opportunities to reduce risk. You can forward sell some grain. Are the prices good? Well, why not? And again, you've got to look at your production risk with grain. Are the prices good for wool? Okay, I might sell some 18 micron forward. I think the price for 18 micron is around 2,000 cents. Now, I can tell you that 70% of the last 12 years, the market has been below 2,000 cents.
Rob, if you're dealing with commodities like wool and grain, which can sit there and show forward, that's great using incentives. How do you go on the lamb side or beef side when product's ready? If you say no, you're going to hold it for 3 months. What's
a really good question. And I'll talk about what's evolving in lamb in a minute. But that is a good example of, okay, let's just say I can't forward sell my lambs. We'll talk about it. I think that's changing. That means I've got to carry that risk. Think of that as a risk. How much risk is that to you? You've got to carry that. But I can forward sell my wool and I can forward sell some of my grain. So if I want to reduce my risk, that's the areas I would focus on. And in fact, wool and grain are very easy for us to forward sell. Very easy. We don't have to, you don't have to deliver it anywhere. You know, you can forward sell on swaps and wool swaps. Just on the lamb side though, going back to my previous comments about demand, we will see an increased appetite for processors to secure contracts. And Gundagai Mates in this area are a leader actually. Not that we have anything to do with it, but we talked to Will a bit. We don't have anything commercially to do with it. They are a leader in identifying the risk is supply. And so I think we'll see, at the moment we see processors come out and say, I'll give you $8 for whatever, or $9 or $7 or whatever. we'll see more sophisticated contracts come out where they'll say, we will give you the market price plus a premium for your quality if you can deliver. And those relationships will become two-way reliant. So the producer will rely on those relationships because we know where our lands are going and we've got a ready buyer, but the processor will be relying on that supply. And our challenge as farmers is to, can we understand what their needs are, and can we become a reliable supplier? The easiest thing to do with lamb and wool and anything is grow it and just sell it on the day. That's easy, and there's nothing wrong with that. You know, there's always a market there. But to get the advantage of being a supplier and get the premium that those processors are going to pay means that you have to think it differently. You're now not just a grower and a seller. You're a supplier of someone else's raw product need. And the example of responsible wool sourcing is an example of that. We will see, if that continues at this level, we will see processors coming out to you guys and saying, we will give you a premium, but we want to secure your supply. My approach would be, say, yeah, okay, I'll take the premium, but leave the market float. Okay? So let's say they say, we'll give you 300 cents a kilogram extra, or in lambs, let's say they give us $1 a kilogram extra. So yeah, over the Eastern United States Trade Lamb Indicator, and then I'll go and lock in the wool price. Lamb's not a good example in that case. But so what I'm saying is if I can go and lock in the wool price at $2, 2,000 cents, $20, and they say they're going to give me 250 cents above, I'm going to get $22.50. But if I'm a wool processor, I might be sitting here saying, that's at the 80% level. I don't want to lock in that, but I want supply. So the way I lock in supply, it's called a basis contract. What I lock in supply is the premium I'm offering you to be a supplier, and then the market will determine what that premium is above. But if you're in wool, and you can do it in wheat, I'm not sure, I haven't figured that out yet, but in wool, you could then go to the forward market and say, I'll lock in the 18 micron indicator at 2,000, knowing that when I sell, if the price is lower, that indicator is going to bring me up to 2,000, plus I get the 250 cent premium on top of it. Now that's where you'll find wool brokers will be heading in that direction to try and facilitate those sort of deals. And you've already got people like G. Schneider with Responsible Authentico coming out and saying, you know, we're happy to do those sort of things. Again, you go from being a producer and a seller to a supplier. So, yeah. That's my 5 minutes, isn't it?
Yeah,
You
it
think?
is. Yeah.
If you'd like, we'd love you to tap it. Anyone's interested in podcasts, I never was, but once you start, you get hooked on them. And we do one comes out once a week. This week I'm talking to Charlie DeFagley about the demise of government investment in agricultural R&D and extension. We also talk about the markets a bit, and if you'd like to know any more, go to mercado.com.au. We'd be very happy to have a look at it. Is there any? I'm going to be starting another question. Sorry.
I had a couple that came up. Talked about quality assurance and some of those schemes, which I haven't heard of any of those, but most of us would do MSA, which from the land away.
Yep.
I just wondered whether you thought there was a market premium, I guess across the board, because most people would do that. That was one. The other one was biosecurity risk in foot and mouth, apparently in Bali there recently, and they're talking about reducing the number of people who go there for holidays or something. How much of a risk is that?
It's so in percentage terms, the foot and mouth getting to Indonesia doubled the chance of us getting it in the next 10 years. I think it went from 8% to 28% that we will get. So that is your answer to the question, has the risk increased? I was saying to Charlie earlier, with foot and mouth, we still have to do something wrong. Someone has to come in and get through biosecurity, get to a farm, and that's how it spreads, or bring in contaminated product. But it is a huge risk for us. And if you think about it, go back to the 70s and 80s droughts when we were shooting. No one is old enough for that, is it? Anyone around the 70s? We got paid $1 to shoot an old sheep in Victoria, anyway. The last droughts, what happened to the mutton price? It held remarkably well, considering the amount of mutton we sold, because we have export markets. 70s, 80s, we didn't. In fact, back then we used to put mutton in pies. We can't even afford to do that anymore. So that's the first thing that would go. And that means that our old cows and our mutton, our surplus mutton, would, I won't say be worthless, but they've got nowhere to go. Because 65%, I think I mentioned it, 65% of our markets need us to sign up and say we haven't got FMD or lumpy skin disease. So even if we brought it in as a vaccine, that changes it. Even if we vaccinate, we've still introduced the virus. The virus is there. Now that means we would have to go and renegotiate those markets. And they will be the high-level markets, high-end markets. And that will test our relationships then, whether we can go back and say, oh, by the way, we've got these protocols, can we actually drop this one out there? We saw in South Africa, China wouldn't take any wool. So that's the first thing. So then they've got to fumigate all the wool and get that going again, but they certainly won't be taking meat from South Africa. So that's a big challenge. I think we certainly won't be stopping people going to Bali. The government won't do that, in my opinion. That won't happen. I mean, from a farmer point of view, that would be a logical thing to do, but it won't happen. So I was thinking the other day, we should have some of our senior farm leaders go and meet with the people who are on border security, the people on the front line who check your bags, and just explain to them what an important role they're doing, how important it is, and put dollars around it. When the US had one mad cow and they couldn't trace it, so they lost access for 5 years into Japan, Korea and Taiwan. It cost the US beef industry $11 billion. Now remember, the US beef industry eats most of its own beef, so it only exports a bit. That same scenario in Australia costs the Australian beef industry $55 billion. And the Cattle Council says it could be up to 100 by the time we eradicate it. So the importance of biosecurity, and I know I'm in New South Wales now, but you guys have got to embrace the bloody EID for sheep. I mean, it's just a logical step that's going to give another barrier, and in terms of managing risk, it means that we will be able to trace anything much quicker. But even if we don't get it, what it's done, it's made it harder for our competitive markets to compete with us. It's lifted the bar for a couple of dollars a head when lambs are making 200. I just don't get it. But that's sorry, I am a director of sheep producers, so that's my little bit now. But biosecurity, in terms of your farm incomes, is a greater risk now than drought right now. A greater risk.